Alarm Bell Checker 2026, Late Cycle Signals Before Real Yields Go Negative. May 13th, 2026. Flint West Reporting. Section 1. Pinpoint Brief. There is a strange feeling in the air right now. The numbers say resilient. The markets say everything is fine. The headlines scream artificial intelligence, productivity boom, and new technological revolution. And yet underneath all of it, something sounds wrong. Like a machine vibrating slightly out of rhythm, because as of mid-May 2026, the United States financial system is operating inside a higher for longer regime that most people are still psychologically unprepared for. The era of free money is over. The 10-year Treasury yield sits around 4.38 to 4.42%. Real yields, measured through tips, remain near positive 1.93%. 10-year break-even inflation expectations hover around 2.45%. That combination matters because it tells you the market is no longer pricing emergency conditions. This is not 2020. This is not the post-2008 zero-rate world. Capital costs money again. And once capital costs money, leverage begins exposing itself. Section 2. 30-year mortgages now hover around 6.5 to 7%. Corporate borrowing ranges roughly from 5% for stronger balance sheets to 9% or more for weaker credits. Infrastructure projects are becoming harder to finance. Artificial intelligence data center buildouts are becoming brutally expensive. Power costs are rising. Fuel costs are rising. Commodity supply chains remain unstable. And yet the Standard & Poor's 500 keeps making all-time highs. That is the contradiction. A tiny cluster of hyperscaler companies, Microsoft, Meta, Amazon, Oracle, Google, continue driving the index upward through massive debt-financed artificial intelligence expansion, while broad sections of the real economy are quietly slowing underneath the surface. Housing feels tight, small businesses feel pressure, consumers are stretching, traditional cyclicals are weakening. This is no longer a synchronized economy. It is a two-speed system. One side is connected to the artificial intelligence narrative, the other side is connected to reality. And right now, the artificial intelligence side is winning the psychological war. But confidence is carrying more weight than people realize, because underneath the surface, the alarm bells are already flashing yellow. Section 3. Foreclosures are rising. Not 2008 levels, not yet, but clearly moving upward. Corporate refinancing stress is increasing. High-yield spreads are widening. The junk bond market still functions, but the stress is becoming visible. Meanwhile, hedge funds remain heavily crowded into Treasury basis trades and leveraged swap trades, a structure dependent on stable collateral conditions and stable repo financing. That is where things become dangerous, because modern financial crises rarely begin where people expect. They begin in the plumbing, and the plumbing right now is carrying extraordinary leverage. This content is brought to you by Bobby Gigs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 4. Private credit has quietly become one of the most important pressure points in the system. Fitch's United States private credit default rate now sits at 5.7% through Q1 2026, with a record 24 unique defaulters appearing in a single quarter. That is not normal. Even more important is the rise in what many call bad PIK. Payment-in-kind structures allow struggling borrowers to stop paying cash interest and instead roll the interest into the loan itself. In plain English, the borrower cannot afford the payments anymore. So instead of admitting the problem immediately, the debt balance quietly compounds underneath the surface. That is why bad PIK behaves like a shadow default. And shadow defaults are exactly the kinds of hidden fractures that appear before larger systemic events. At the same time, margin debt remains extremely elevated, near $1.221 trillion. The leverage has not disappeared. It has merely migrated. And now we arrive at the real issue: artificial intelligence collateral. Section 5. This is the new ingredient. Billions upon billions of dollars have now been committed toward data centers, chips, compute infrastructure, and artificial intelligence expansion under the assumption that future productivity growth will justify today's spending binge. But what happens if the timelines disappoint? What happens if revenues lag behind expectations? What happens if depreciation hits faster than projected? What happens if energy costs keep climbing? What happens if hyperscaler debt spreads widen further? Because if the collateral at the top of the pyramid weakens, the stress begins moving downward through the entire leverage stack. And this is where the system-wide auto-deleveraging event enters the picture. Section 6. Auto-deleveraging, the unwind, the cascade. Retail borrowers weaken first, then corporates, then private credit, then hedge funds. Then suddenly the treasury market itself begins destabilizing through forced liquidations, widening spreads, repo stress, and collateral deterioration. And once the collateral base begins wobbling, the Federal Reserve eventually has no choice. That is the moment everyone is truly waiting for. Not because they want collapse, but because they understand the sequence. The moment the Federal Reserve pivots aggressively, through rate cuts, emergency facilities, liquidity injections, or some future version of yield curve control, real yields begin collapsing towards zero or negative territory. And historically, that is where Bitcoin catches its strongest bid. Not simply because of inflation, not because of memes, but because Bitcoin functions as a hedge against financial repression itself, against the destruction of real returns on capital. And that distinction matters enormously. Section 7. Now, to be clear, we are not in 2008. The banking system is stronger. Repo backstops exist. Large technology companies still possess enormous cash flow reserves. But we are also not in the free money decade anymore. The debt supercycle is larger. The leverage is more distributed. The collateral chains are more interconnected. And de-dollarization pressures are slowly forcing treasury markets to rely increasingly on leveraged domestic demand structures to absorb issuance. That is why the alarm bell checker matters, because right now the dashboard still says yellow, not red. The repo market remains stable near SOFR around 3.6%. No major liquidity freeze exists yet. The system still functions, but the fragility is rising, and the transition from contained stress to cascading deleveraging tends to happen slowly, then suddenly. That is the window being monitored now. Not panic, not certainty, positioning. Watching for the moment when multiple yellow lights flip red simultaneously. Because once that happens, the probability of negative real yields rises dramatically. And once negative real yields return, the next phase of the Bitcoin trade likely begins with it. Stay disciplined. Update the dashboard monthly. The yellow lights are not sirens yet, but they are louder than they have been at any point since 2023. Flint West, signing off.